Hello, everybody, and welcome to the Property Pilot Podcast. This is episode 8, and I am Brian Graham. Today, I'd like to talk about my real estate investment journey. One of the main reasons is because I've been getting a lot of insight and questions as to how to get started. And I think it's still difficult for the average person to realize that they can achieve financial freedom. It's difficult for them to get started because they're afraid to make that big investment. Most of us, like to put $100 to $200 a month into stock market or our 401ks, but we're afraid to put that first, $10, $15, $20,000 into a real estate investment. And I get it. It's challenging. It's scary. So let's just get right into it. I'm going to explain to you how I got started in real estate. I'm going to talk about my first investment. My first investment was a property in 2018 that cost me $92,900. It was located in Mississippi, northern Mississippi. And bear with me because I'm going to be looking off camera so I can check my notes. I purchased that property at 15% down. That totaled, with closing costs, about $18,600 out of pocket. It cash flowed $200 a month. So my cash on cash return was about 13%. And that wasn't horrible. The stock market gives anywhere between 7 to 9%. So 13% is great. I had that property for 2 years and I sold it in, I think it was August of 2020. Over the course of the 2 years, I had one repair. It was a $1,200 water heater, which technically wipes out 6 months of cash flow. But after 2 years, I then listed that property for sale for $125,000. So now we're looking at close to a $30,000 gain. I ended up selling that property for $122,400. They asked me for $2,600 back, or a discount, for flooring repair. And, it is my recommendation that when you have made such a significant gain and you have a cash offer, don't nickel and dime each other. They asked for $2,600 back. Fine. Take it. Why would I put that contract at risk for trying to save $2,600? For all I know, a different buyer would have come along and it would have been, could have been for less money. The next offer could have been for less money. It could have been that it would have been a first-time home buyer and that person's financing would have fell through. I mean, who knows what could have happened? So after expenses, fees, realty fees, I didn't offer any closing cost help, but after realty fees and expenses, I profited about $22,000 from that deal. So I had an $18,000 investment that made me another 22 grand. So I more than doubled my money. So it was a great investment over 2 years. So what then I chose to do is a 1031 exchange. A 1031 exchange is where a real estate investor can sell a rental property and defer the capital gains into another property. You have to meet very specific criteria, and if those criteria are not met, then you have to pay the boot, which is called the tax, capital gain on whatever amount of money that you made. So a 1031 exchange is a very, very powerful tax incentive for real estate investors to continue to invest in real estate. So one of the rules is you have to use all of the money that you have gained and that was in that property. You have to use the equity, you have to use the capital gain, you have to use all of it. So when all was said and done, I had about $50,000 to reinvest into other property. I turned around and I bought two other properties. One property was a mixed-use building. It was 3 units. I bought it for $160,000. And that was interesting because it was actually listed for $180,000. This was also in the middle of Tennessee, a population of 6,000 people. But it was a mixed-use building, 1 commercial tenant and 2 residential tenants. It was listed for $180,000. And my realtor said this would be a great deal. And I punched the numbers and it was. 180 was great. So I called around to local lenders because this is considered a commercial building. Mixed-use buildings are considered commercial. You have to go through a commercial loan process. You can't just go buy a residential, buy mixed-use building with a residential loan. The banks won't let you. And so I went ahead and I made an offer I did not make an offer yet. I went and shopped around to different banks. I came across a local regional bank that had one location. And they said, oh, yeah, we know where that property is. It's actually right around the corner from us, but we think you can get this for $160,000. I said, oh, 160, great. So I made an offer for 160, and it was accepted like that. It was accepted that day. They actually paid all my closing costs. And I was like, what the heck? I didn't even ask for that. Well, it turns out that property had been foreclosed on, and I didn't know it. So do your due diligence. And I thought I had, but I didn't realize the property had been foreclosed on. But the bank, imagine that, the bank I was going to use to finance my deal actually helped me figure out the price of it. Not my real estate agent, not any of my property management company. It was the bank that helped me get a better deal on that. And it was not the bank that had foreclosed. So it's not like they were, wheeling and dealing. So the property ended up cash flowing me $1,100 a month. The other property I purchased at the same time, because I had leftover funds with the 1031 exchange, I had $50,000 to use and a $160,000 property at 20% down. I still had 18 grand left over. So I bought a single family home for $119,000 with a 3.6% interest rate on an investment property, which is unbelievably good. And I bought that property for 20% down. So that was about 24 grand. I had to come out of pocket about $6,000 to $7,000 to close on that deal. So I had one unit that cash flowed 200 to begin with, and I've now snowballed that into 5 units with one commercial tenant that then produced $1,600 a month. So you may hear from investors, I never sell, never sell. Well, if you do your due diligence and you find better investments, the equity that is often in a single property from that appreciation value, you could end up making a lot more money if you put that equity to use. So I took the equity from that original property. It only cash flowed $200 a month, which is not going to change my life. But then after 2 years, I was able to snowball that. And now those next 2 properties and now 5 units is producing $1,600 a month. So now I've 8x'd my cash flow in just 2 years. I mean, that was unbelievable. The mixed use building, the story behind this is very interesting. There was a commercial tenant and 2 residential tenants. The commercial tenant was a State Farm agent. So I thought, insurance broker or insurance agent, this guy's going to pay no problem. Well, what come to find out, the reason the building was foreclosed on was because they foreclosed on him. And that was mind-blowing. I thought, oh no. Now I have a commercial tenant occupying the office space, but I don't know if he can pay. So we agreed on rent, and he was paying in cash, but it wasn't the first of every month. He was paying on the 10th. He was paying on like the 5th of the next month. So it went on for 2 months. He always ended up paying, but it wasn't a real estate investment I wanted to be involved in. And, I always say in sports that you need a lot of luck to win championships. Well, it's the same in business. You do need some luck. And by the grace of God, someone called me and said, hi, I'm actually an attorney looking for space to rent. I was interested in buying the property that you bought, but I'd like to rent it from you. And so then I served the State Farm agent a 30-day notice to evict or to vacate. And then I took the other person at their word. And I said, I'd like to sign you to a lease if I get this guy out. And she said, okay. And so I signed her to a 3-year lease with steady rent increases. And I actually offered her a lease option. This is where we agree upon a price where at a later date, she can purchase the property from me at the agreed upon price from the prior date. And so I offered the property to her at $200,000, and she turned me down. She chose to not do it. And I actually, a year later, sold the property to her for $230,000. So she It made me 30,000 more dollars, but it cost her 30 grand for not making that original deal. And then what I decided to do at that point was, again, a 1031 exchange. So now in that property, I had $100,000 of equity. I had $100,000 of equity to now take that mixed use building and buy other property. So what I did was I decided that's a lot of equity, and I followed the terms of the 1031 exchange, and I needed a way to get that money back in my pocket. And so what I did was I bought two separate 3-unit buildings. Both of those buildings cost about $140,000. My wife and I put in about $80,000 over a 6-month period to renovate them. 40 per property. If you round up, probably 50 per property. So we're all in for, I would say probably 40 per property. So we're all in for 80 grand on these properties. Well, what we were able to do was the BRRRR method. And it worked out to where we were able to increase the value of these properties to about 200 grand. So we made 20 grand of equity. But we did a cash out refinance and we pulled out about, let's see, I think it was around $120,000 of equity. We pulled out $120,000 of equity in a cash out refinance. So when all was said and done, we were only out of pocket about 50 to 60 grand, between 40 and 60 grand on these properties. And it was just as if we had bought those properties with 20% down. But this allowed us to pull our equity out from the previous 1031 exchanges tax-free. So really it was not a loss, but not a significant gain to purchase these properties. And then those properties now cash flow about $2,500 a month. So again, only out of pocket like another 40 to 50 grand. So significant investment, and it took a lot of work. It was very stressful, but we got those properties rented and they cash flow very well. I then took that income that we got from the cash out refinance. I took that equity and I then bought 3 other properties. This totaled up to, those 3 properties had 7 units total, and it cost about 70 grand out of pocket from that refinance money. So it cost about another 70 grand, and those properties now cash flow $2,100 a month. It's about $2,050 a month. So in this area, I also bought another duplex that cash flows about $1,500 a month. Sorry, I'm getting ahead of myself. So those 3 properties I came out of pocket $70,000, and they were turnkey. They were all already rented. I now have gotten all of those tenants up to market value rents, and they were turnkey. They don't need any renovations. They could use some cosmetic upgrades, but I've got them up to market value rents, which was only an increase of about $50 to $100 a month. So it's not like I doubled the rent or anything, but they produce about $2,050 a month in cash flow. So up to this point right now, for my first investment, I backtrack, we have $200 a month in cash flow. And now we have, for 1 unit, and now we're up to 14 units that produce about $4,000 a month in cash flow, $4,500 a month. So in just 2.5 years, I guess we're up to this point, we're at 3 years. I'm sorry, I'm losing track here. Up to 3 years later, after starting real estate investing, I go from $200 a month to now $4,500 a month in cash flow. It's pretty significant growth. Then what I decided to do in the beginning of 2023, I purchased a duplex, and then I decided to perform an outright BRRRR method: buy, remodel, refinance, rent, and repeat. So you buy a property that is distressed in some way. You remodel the property to get it looking at market value cosmetically and functionally. And then you rent the property to get a tenant in there And then you go to a bank and you ask for as much money out of pocket as you can, and assuming all the numbers still work, to cash flow. And you do a cash out refinance to perform and get all your equity back and your entire investment. That's the goal. And hopefully, and some. And so I'm up to the point at this stage where the entire remodel is done and I'm about to rent it out to the second tenant. And then I will go to the bank and get a cash out refinance. So that property before the refinance will cash flow $1,500 a month. When I refinance, I should be able to pull out $80,000 to $90,000, and I'm only 70 grand into it, but I should be able to pull out $80,000 to $90,000 of equity, and it should cash flow $700 to $800 a month after that. So that one will be a very good investment. So that takes me up to 16 units. Just recently, I used a private lender. I bought another duplex, and that property cost $78,900. At the time, the interest rate for a normal bank was 8.5%. I was talking to a client about this, a client I work with, and he said, well, how about I do 7.5%? I said, okay, done. Because it was way better than what the bank could have given me at the time. And so it cash flows about $350 a month. And if anything, I can refinance whenever I'd like to. And maybe I'll do that if I get a 7 or 6.5% interest rate. It doesn't really make sense right now because we have a 30-year term. But again, it was a very easy deal. It was done in 2 weeks. I bought up another property, a single family home in Memphis, Tennessee. This was a $90,000 purchase. And at the end of 2022, it also makes me $200 a month. That property, if I sold it today, I could probably sell it for close to $130,000 or $120,000, which, similar to my first investment, is since that's what I did, is a 1031 exchange. I'm going through a lot of changes right now with my personal residence. I've recently bought a new house to live in, and we'll move in June, but I will probably end up selling that property in Memphis because, it's lost equity. It's equity that is not making me any more money. The property, I bought it for 90. It's worth 120 to 130. It's just equity sitting there, not making anything else. As you can see, what I've explained is I took a similar priced property in 2018 and I snowballed it to 17 units. I could hopefully do the same with that one. So that's what I'll probably do. So right now, my current portfolio sits at 17 units across 9 separate properties, since a lot of them are multifamily. It generates a total amount of $5,600 in positive and expected positive cash flow. Now, there's always expenses. That includes the expenses, though. If there's no expenses, it produces something upwards of $6,600 a month in cash flow, $6,700. But there's always expenses, and a couple of units are currently vacant right now. But if all is said and done, when the properties get rented, it'll produce $5,600 a month in cash flow. I hope you enjoyed this episode. I really wanted you to hear what my investment journey was like, because it did not start by investing millions of dollars. It did not start by inheriting anything. It started by reading a couple books, doing your due diligence on what areas to invest in, talking to other professionals, learning their experiences, and then doing basic math. Is, what is this property making me? Is that equity better used elsewhere, even though the current investment is good? How do I continue to snowball that into bigger and better investments, and do it intelligently? Because when I calculate over the last 5 years how much money I've personally come out of pocket, it's minimal compared to the amount of growth that this portfolio has attained. So I'm going to continue to do that as my properties appreciate and the interest rates slowly fluctuate. Once they become low enough or I'm happy enough, I'll refinance the entire portfolio. I haven't decided yet if I'll pull cash out or not. I think that'll depend on what they're going to be worth and if they will still positively cash flow. If the interest rates are good enough, I may perform a cash out refinance and then buy more properties, or I may choose to leave it there just so that way I can reset the long-term the 30-year note, or reset the 30-year note, and then I'll lower the interest rate and the cash flow will be even higher. So it just depends on really how much equity I have at that moment. So to go from $200 a month to then $2,400 a month, and then the $5,600 a month, and then $67,000 a year in passive, not, I wouldn't say passive, because real estate is not a passive job. You need to still manage the managers. Even if you're out of state or in state, it does take time out of your day. Unless you hire somebody that is a manager of the managers that can take your spot, then it truly becomes more passive. But I highly recommend you're not a passive investor. Don't be a passive investor. Be somebody that is involved in your business. And I find mistakes that my team makes all the time. My managers that accidentally double charge me, my contractors that are telling me a job is done when it's not, my real estate agents that I ask to let me know about a listing and they never get back to me. You always have to be involved. And if you're not, it's just lost money. Sometimes just keeping up on the logistics is enough to make sure you're not being taken advantage of, and that your portfolio is growing the way that you want it to. So scared money don't make money either. And my advice to the person that's sitting there scared to buy that first property because they watch videos on they're scared because of interest rates. They've watched videos because investors are telling them don't buy, now is not a good time. If there's anything I've ever learned, it is never a bad time to buy real estate. Never a bad time to buy real estate. Somebody will always need a place to live. The housing supply is still very low. Demand is still very high. And as long as you are not buying in a very high crime area, if you have done your research on the type of strategy you want to use and the area that strategy can thrive, you will have success. So, good luck. Comment below. Let me know what you think, and I'd be happy to chat with you. Let's talk about your investment strategy. So, good luck, and thanks for watching. Hope you guys have a good week. The advice and recommendations I offer are intended to be informative and educational, drawing from my own experiences in the real estate market. It is crucial to recognize that every investment decision carries risk and outcomes may vary. I am not a financial advisor, and the information provided during these podcast episodes is not intended as financial, legal, or professional advice. It is your responsibility to conduct thorough due diligence, seek the advice of qualified financial professionals, and make informed decisions based on your individual financial situation and goals.